Yeah, but thanks for being here. All right, so we're just gonna just get started here. So yeah, I just put this together in the last couple weeks. So just a study of declining markets, history, human behavior, and then we're going to get into some actionable items that you can do on your end that will likely benefit you longer term. So, all right. So first slide here. This is the S&P 500. So the United States, the largest 500 publicly traded companies. From January 2019 to today. Right, so obviously, let's see if I can do this. Really testing myself. Yep, okay, good, I can draw lines. All right, so obviously a really smooth, really nice year, 2019. Then of course, we all start hearing about this little virus. Everyone thinks it's gonna be contained. In China, not so much. Our whole country shuts down. And since then, a subsequent little rebound there. One of the things I want to point out, and it'll be, we'll bring it up in a little bit more detail later in the call, but this idea of recency bias. Okay, so there are a lot of different behavioral biases that are human brains, the way we process information. And recency bias is a really, really dangerous one. And all that means is putting, us humans, we tend to put a tremendous amount of emphasis, of weight on what's happened to us most recently, okay? And we tend to forget about the way things have gone in the past. All right, so we're going to, let's see, where's my little mouse here? Okay, clear. I'm gonna get better at this as this goes on here. Okay, so just to back this up a little bit further. So next slide. So all we've done here, same S&P 500. So we have the exact same, again, 500 biggest US companies. Now we're just backing up to, including the previous decade. So going back January 2007 until today. So of course, 2007, housing bubble, financial crisis starts. We head down, market bottoms in March of 2009. And then for the last decade, it's just been this straight line higher for the most part. Yes, there's been, some little things. You have European debt crisis. Here we have, Brexit, period of time leading up to the US election. Remember 2016, you have a little hiccup here. And then at the end of 2018, we have, the China trade wars start. We had a decline there. But for the most part, this line that's straight up. And one of the points I want to make, what we've experienced recently is it's not that abnormal at all. What's actually been abnormal is this lack of volatility over the last decade. This is strange. And so going to the next slide, just to continue to put this in perspective. So what we did here, now this is going to shift to a bar graph, but now we're going back 43 years. Okay, so the most recent 43 years of market data that we have. And what this is, that each of these bars represents how many years. We're looking at the largest drawdowns in each of the last 43 years, right? So for example, this first bar right here, this tells us there's only been 3 years in the last 43 where the largest drawdown in the market was 5% or less. Okay, that's very unusual. What I found interesting, and I hope you do too, the most common drawdown that we have, 10 to 20%, right? So 17 years out of the last 43, we have a market drawdown, of 10 to 20%, right? And then of course, we have some bigger ones down here. 2020 is going to end up being down here. Of course, the drawdown at the worst was quite a bit past 30%. Small caps were down more like 50% at one point. But I hope the idea here is just realize, like, more than half of the time, like you're on this side here. So again, that going back to recency bias, like in our minds, because things have been so smooth the last decade, we've kind of forgotten the way markets work most years. If you just take a little bit, you use a little bit more of a historical context. All right, so I thought this was an interesting point. So the question, do downturns always lead to down years? All right, so, and I know we're in a webinar format where I can't hear a bunch of answers, but it'd be kind of fun if people started to guess. But so the question asks, what has been the return of the S&P 500 in years when the market experiences a correction of greater than 10%? Or another way, like I kind of like the question asked, if you knew the market was going to go down 10% in a year, like, would you choose to invest in that year or not? Right? So if there's a way you knew ahead of time, would you invest in that year or not? And I thought this was really cool. All right, so 64% of the time, 64% of the time, even with a 10% decline at some point in the year, the market still finishes higher. So the conditional probability that the market finishes higher, even given the 10% decline, it's still 64% of the time, about 2/3 of the time, you still have a positive year. And where's my mouse? Oh, not. All right, so we know in any given year, the market's higher about 4 out of 5 years. Right, so even knowing ahead of time that we were going to have a decline of 10%, 64% of the time the year ends up higher. Yeah, I thought that was fun to share. And so, just last little point here, like, although market corrections are frequent, many times we can still expect a respectable return for that year. And along those lines, like this, I thought this was terrific. Dimension, I'll put this out. So what we're showing here on this, again, another kind of bar graph, but what I want you to focus on first is each of these red dots on the bottom. All right, so minus 18%, minus 29, minus 33. These are the largest intra-year declines for each of these years. So now we're looking at a time period from the year 2000 to 2019, right? So what's the largest drawdown during those years are these red dots. All right, and then the solid bars are those are showing what the market ended up finishing the year, right? So for example, let's look at 2002, for example. Right, so of course you're coming out of the dot-com crash, terrorist attacks, recession. So 2002, the market, low point, minus 33% at its worst point, and then it ends up, down 22. But what's interesting, you see a lot of these other years, like 2023, and this is going to be a common characteristic of the way markets rebound after crashes. See, 2003, at one point, the market was down 13%. But look at this, it ended higher, 31%. All right, so you have, a 44% reversal there within the year. All right, again, pretty common here through the first decade of this century. And then, of course, we hit the financial crisis, 2008. The low point in 2008, minus 49%. That year, the market ended down 37. Now we know the market didn't bottom in 2008. It actually bottomed in 2009. which is why you have another big red dot down here, down 27%. Right. So what that tells us is, the beginning of 2009, so the months of January, February, and then the first little bit of March, the market went down 27% just in those first couple months. And then yet again, this theme of markets rebounding fast, and I mean, it happens quickly and violently. 2009, the market actually ended higher 28%, right? And then we take off on the bull market that we've been on for the last decade, right? And so you see these little points here along the way. So here you have the 2018, we have the tariff, the trade war starting, market ends down a little bit there. And then we'll see, right? So 2020, of course, we don't have a data point yet. Like as of now, the red dot would be about right here. We'll see. Hopefully that's as low as the red dot goes. Hopefully the bottom's in. I'm not going to predict that today, but it very easily could be, right? Because right now the bar would be right here. So if the drawing's actually better than I thought I could do. That'd be about what the bar would look like if that were the case. Right. All right. Okay, so moving on. So expected stock returns after crash. So kind of continuing on to this point, like when you're in a crash, after a crash, like what should we expect moving forward? What does the data say? All right, well, there was a really nice report that was put together recently, 2017, research paper titled Negative Bubbles. I thought that was a great title, Negative Bubbles, right? Like we've all heard about the .com bubble or the housing bubble, but so negative bubbles. All right, so this research paper, William Goetzman, he's a bright guy. He does economics at Yale. He's put out a bunch of really neat things. Not as familiar about this docile Kim, but Goetzman's done a lot of really cool things. And so what this research paper, I mean, they studied everything. I mean, they went way back. So 101 global stock markets from, I mean, over 3 centuries, right? So they went way back. And what they did, they found every single crash that they could, 50% or more, right? So they were able to find over 1,000 crashes in the last 300 and whatever it is, 35 years to study. And so what they found, and we could put a bunch of charts up here, but I know most people just like the main points. It was very apparent, like with empirical evidence data, that the probability of having extremely high positive returns is higher following a crash than any other time. And so they studied a lot of different things, like why this is the case. Economics, is it fiscal, monetary policy? They tried to test all these factors, what they thought the biggest reasons why returns tend to be higher following crashes. And the conclusion they came to, which obviously gets back to the title of their paper, behavioral theories seem to drive the results. Temporary, severe negative sentiment about the stock market, right? So in other words, it's just irrational. People feel, with acting out of fear, irrational selling leading to negative bubbles. So bubbles on the other side. And we talk about it a lot, like the way the markets will work, kind of like a pendulum, where it'll swing one way and it'll probably swing too high, right? You get that irrational exuberance, people that usually don't invest, but the market's done so well the last few years, everyone's kind of jumping on the wagon, and things are going well. And I think a lot of times you probably do see the markets trade higher, right? And that creates bubbles. But kind of the conclusion of this paper, which I thought was really interesting, is like the exact same thing occurs like when things start selling off. There's irrational selling, this temporary, as they put it, temporary severe negative sentiment that can actually lead to negative bubbles. And of course, you know, from those points, that negative bubble, that's why they believe markets snap back as fast as they do into recoveries. So I thought that was, you can look up that paper on it. I thought it was neat. All right, so looking here at the U.S. more specifically in the U.S. Let me try to get my pen out here again. Try not to screw this up. All right, so now we're looking at just the U.S. So not globally, and we're just looking at the last 100 years or so. So from 1926 through last year. All right, and so what we have here is we have a data set of expected returns, okay, after 10% market declines, 20% market declines, 30% market declines. And what you'll notice is across the board, like, these are all terrific returns, right? So after, for example, after a 10% market decline, we would average 11.6% return the year following, a 10% decline. 3 years out, we can expect almost a 33% gain. 5 years out, 67% cumulative gain, right? So, and you see, so even 30% market decline, we still expect a 50% return 5 years after the fact. So point being here, like, I don't think anyone would be upset with 50% or 71% or 70 or 68%. Like, these are all terrific returns. Not just terrific, but above average, right? So if you're ever going to pick a time to invest, like when markets are crashing is almost, it's pretty, like, you probably couldn't pick a better time to invest or continue investing as markets are declining. So I thought that was some worth showing as well. All right, more specifically, and I'm not going to go into a lot of detail here just because, again, we want to do future webinars, and I think this would be an interesting topic. We might do an entire 30 minutes on this next point, but there are different pockets of the market that have higher returns than others in recoveries, right? So it's not just like all, like, well, for the most part, the entire market will rebound, but certain pockets of the market will rebound and have higher returns than others. So, for example, like value stocks. Value stocks typically have higher returns than growth stocks. Another point, small cap stocks tend to do very, very well coming out of recessions and market declines. And actually, like, these both value stocks and small cap stocks, like, we actually expect that there's data that shows that these two factors, we call them factors, that these actually outperform in almost all cycles of the market, but they just seem, the data shows that they're most prevalent. You get these excess returns as markets are recovering. So, and again, we're probably going to go into this in a lot more depth in a future webinar for those nerds, like you, like I am out there. If anyone else wants to learn about these, yeah, we'll probably do another webinar on these. Okay, so we think it's really important, maintain a rational perspective. Okay, so periods of negative returns are a feature of equity markets. Okay, it's not an anomaly. Expect it. They're inevitable. Embrace it. It's just a part of investing. Number two here, ensure you're taking the appropriate action throughout a market decline. Okay, like, this is a big one, and I'm going to go over it in 2 slides. A couple of the basic ones, but you definitely don't just want to be sitting on your hands a lot of time. That there's things that you can be doing to benefit your financial plan, retirement plans. I think it's important you recognize your behavioral biases. And as I touched on earlier, like especially this recency bias. We see this a lot. All right. And just to kind of going back to this slide, this is the slide we started on today. I just want to tell you a little story that I think just kind of illustrates this point. So one of my favorite clients, we were doing a review. Yeah, I think it was a week or two ago, and of course we're going over their retirement plan and everything, and then I get the question. She says, Johann, how much money have we lost in the last since this has been going on? And so it's a 7-figure portfolio, and so we have the software. Of course, it's really easy for us to look this stuff up, and so we calculate it. And of course, she's talking about this period right here, and of course the market's rebounded a little. So I think we did the meeting. It was probably right around this time. And so I look it up and I say, I'm going to make up a new name. Let's call her Jessica. I said, well, Jessica, your portfolio in this short period of time has lost $225,000. And the phone got kind of silent. I was like, and then the reason I started with this chart, I asked her a second question. I said, Jessica, how much do you think this portfolio has gained or lost since January 2019? So let's just add on, let's just add on another 12 months to your returns here, okay? And so you can kind of see where this is going. But of course, we pulled it up, and even including this horrific month of, this has been a nasty decline. Small caps around 50% at one point. This has been ugly. And so I asked her, I said, Jessica, how much do you think you've gained or lost since January of 2019? And she says, I don't know, how much have I lost? I said, well, your portfolio is up $150,000 in this time period, even including these recent losses. And I think the reason I bring this up, I think, so many of us get caught up in this recency bias, myself included. Market declines are stressful. It's that's just our human nature. And I think if we would all just take a step back, have a better perspective of history, and realize that things like this happen. And as long as we have, well thought out financial plans, retirement plans, that's why we plan for things like this. Okay, going to next slide here. Okay, so kind of to wrap things up here, like, given historical data, like, what is the most effective course of action during challenging market conditions? All right. So what should you be doing? All right. Number one, if you're still in the accumulation phase of life, okay, so like I'm looking at our attendee list here, like we have a couple young physicians, a couple other young professionals. Like if you're not retired yet and you're still earning money, you're fortunate enough to have a job, during this tough period of the economic cycle that we're in. Gosh, continued contributions. Like, what a great time to be adding money. Anytime the market's crashing, I mean, you should be adding money, systematically, regardless. But when the market's crashing like this, you get to buy more shares, for the same amount of capital. We tell people, so maybe you have a 401k or 403b, and you're contributing, pretty regular. Maybe you're doing like 4 or 5%, just so you get the full employer match. Gosh, if when the market's experiencing something like this, if you can say, gosh, maybe I'll just increase this contribution to 10 or 15% of my income, just temporarily, just while the market's getting smoked. You will be really, really happy come retirement, because you can gobble up a lot of shares at low prices if you would put a plan together like that. Okay, second point here, rebalance. This one is regardless of your age, whether you're retired or you're not retired. Like, this one is huge. This is the one that we see a lot of people make mistakes and really just ignore, not do. Okay, rebalance. You must act to maintain your proper asset allocation. And now my art skills are really going to get tested here. But what I want to do here is give you a quick example. So let's say, we've put together a detailed retirement plan, and we think that your proper allocation for, let's call this an IRA, is 50% stocks and 50% bonds. All right. So again, just to make the math easy, let's make a $1 million IRA. So we're going to have 500K. That's supposed to be an S for stocks. And this circle's supposed to be the same size. Patrick's laughing at me. Gosh, hold on. Oh, where's my eraser? Okay. So I'm going to get better at this next time. I'm learning here. All right. So this is a 50-50. No, this is fun. So we have a $1 million IRA portfolio, right? We have 500,000 stocks, 500 bonds, because we think this is going to be your best asset allocation, so you can live, the retirement you want to live with the amount of risk that you want to take. All right. So Patrick's laughing at me in my ear right here. I got him right here. He's yelling at me. So 50-50 stocks to bonds. Okay. So let's say the market gets cut in half. All right. And when I say cut in half, like stocks get cut in half. Now, for the purpose of this example, a lot of times bonds will remain, relatively steady. Okay. There's different kinds of bonds, of course, government, corporate, but for the purposes of this example, let's say the bonds maintain their value 500,000. All right. But much like happened recently, let's say stocks get cut in half. So they're down 50%. So all of a sudden, this circle is going to be a little smaller now, right? So now instead of your stocks got cut in half, okay. So now this 50-50 portfolio, that's not 50-50 anymore. No, because that's drifted now. The market's cut your stock. Now your inaction has turned this portfolio into a 33% stock, 67% bond portfolio. Now, what's the problem with this? Well, the biggest problem is, given the slides that we've been going over previously, we know what typically happens at market bottoms, right? We're going to have a violent move higher in equity prices. We don't know exactly when that's going to happen, but if you've done zero rebalancing and your 500,000 of stocks has now turned into 250,000 worth of stocks, you aren't going to participate the way that you should. Okay, because now you only have this 250 that's there ready to participate whenever the market bottoms. So in other words, it's going to take you a lot longer to get back to even. Sadly, like a lot of times, it might even mean the difference of you might not be able to do something that you thought you might be able to do in retirement. Okay, so what is rebalancing? Well, in a case like this, after a big market decline, you can kind of think of, we're just going to shave off a portion of bonds like this, and guess where it's going? Right into stocks. We want to get this portfolio back to 50-50. So when that bottom happens, like your portfolio is ready to go and participate as quickly as it can to get you to the, you know, the goals that you want to, the things that you want to do in retirement. All right, the other, so really, really important, rebalancing. And just one last point on rebalancing, like, you know, there's, of course, you know, we do that. We see a lot of, we give guidance to a lot of, you know, do-it-yourself investors, which is totally okay. But that rebalancing step, that's by far the one that we see people make the most mistakes on, right? Because it's difficult. It's difficult to recognize and to act, to implement, make those changes. Sadly, we even see some advisory firms don't take that seriously enough and aren't rebalancing in the right ways. Point 3, strategic tax loss harvesting in non-qualified accounts. All right, I know some of you watch my weekly videos, so it's nice to, instead of, you know, having 3 minutes to talk about these things, you know, try to pack these in, and, you know, a half hour or so. But so tax loss harvesting, and again, we'll probably end up doing you know, another webinar, just because these two are so important. Where's my mouse? There it is. Okay, so tax loss harvesting in non-qualified accounts. Why I point that out is this doesn't do you any good in like an IRA or a Roth or anything like this. It's got to be non-qualified. So we help with, you know, we help with a lot of like non-qualified account, a lot of trust accounts, you know, living trusts, irrevocable trusts, and anything where you have to be cognizant of taxes and you can carry losses. This is where this can be really beneficial. So again, Patrick's going to make fun of my artwork here again, but let's say you have a $100,000 position. Market gets blasted. This position goes down, and now it is only worth $50,000. Okay, what a lot of people do here is they do nothing. All right, and the market eventually recovers, you know, and that's one way to do it, and that's sometimes that's okay, but there's a better way to do it. So instead of doing that, take advantage of the tax code. Your 100,000 position goes to $50,000 position. What we do many times, we're gonna sell this $50,000 position, and importantly, immediately. So not waiting, like trying to time the bottom of the market. No, like we literally do this in seconds. We're gonna sell a position, okay, and we're gonna buy something similar, right? So if this position is supposed to be, you know, small cap value, like we're gonna find something else small cap value, okay? Like it can't be the exact same position, otherwise you get what's called a wash sale, but it can be similar. And so sell and immediately buy, okay? And now what happens is, so again, let's say we do that and we get this same recovery. What's the difference between what we just did and the example I did right before that? So for what we just said, what you're gonna have here is this $50,000 loss because we sold, okay? We're gonna have we just recognized a $50,000 loss. And why that's important, this capital loss, you can actually use this to offset ordinary income. All right, so I know we're getting a little bit, but there's a big difference between ordinary income and you know, long-term capital gain income. Ordinary, like for example, if you're in a higher tax bracket, like you can use $3,000 of this, you know, each year to offset your ordinary income, like your earned wages. You know, for some of you that might be, you know, 40% in some cases in you know, the higher federal tax brackets, you know, certain you know, states, right? So it's this can be huge to have a $50,000 write-off, to be able to write off your ordinary income. Now, meanwhile, like the other example, let's just say it gets back here to 100,000. Well, now you're going to have, instead of instead of, you have this ordinary income write-off, so the capital loss, but over here you're going to have a long-term capital gain. And this is, so this is much more friendly for tax purposes. Depending upon your tax bracket, long-term capital gains are either 0%, 15%, or 20%, right? So it's always going to be lower taxes than, you know, ordinary over here. All right, so really beneficial to, you know, just by taking some action, you get to offset high, you know, ordinary income here in exchange for long-term gains here. Now, if this means that, like, when this gets back to 100, let's say, like, unless you sell it, like, you don't pay this tax at all unless you sell it, right? So one thing we do, especially for a lot of our retirement clients, like, say you're in a position where we might not need this money in your lifetime, like, and so say this thing keeps growing to maybe someday it gets to 200,000. Okay. Well, so let's say it's $200,000 when you pass away and you're gifting it to your kids. Guess how much taxes your kids pay after this whole, from 50,000 to 200,000? Guess how much taxes your kids pay? 0. So this is one of the biggest benefits of the the tax code for estate planning purposes. This is called a step-up basis. Any non-qualified assets that you hold that appreciate upon your date of death, your kids take it over and they get a new cost basis. It's now 200,000 instead of 50,000. Okay, all just because we were taking some action. We got a tax write-off, and then we have a long-term capital gain, and so that's kind of the other action that you want to be looking to take when markets are declining. Okay. Hopefully I haven't bored everyone. It looks like we still have, looks like we only lost one attendee. So I bored someone, but I bored one person. Okay, so how are we doing for time? Okay, a little bit longer than I thought. Some good questions coming in here. Okay, so those were the big things I wanted to touch on. Yeah, lastly, of course, we kind of have a nice mix of attendees here, people that we're already helping, some others that we've had conversations with in the past. We'd be happy to help. So we appreciate you taking the time to listen today. Hopefully you learned a couple things. Hopefully you might want to join another webinar. I think the next one we might even go a little more detail on rebalancing or tax loss harvesting or asset allocation or the small caps. There's all kinds of fun things. We're big nerds here, and we like helping people. So I'm gonna go through a couple questions here. If you have the Q&A button down there, and you have a question, feel free to type one. We've got, okay, here's a good question. Jim. Okay, Jim. How often do you rebalance accounts? Really? Okay, so this is a really good question. The answer to that is every single morning we have a software that scans every single account that we help. All right, that we're looking after. Every single morning we scan every holding of every account. And we have what's called tolerance bands. Okay, so, and again, this is why it's going to take a whole webinar to go over rebalancing. I think we could probably do some better examples than me and my horrible artwork. But you can think of tolerance bands as, all right, so think of it, so if we have like a target position, right? So we want a certain position in an account to be 10%, right? We're going to have like an upper limit where we'll let that position drift to, will also have a lower limit that will let that position drift to. But as soon as it breaks one of these limits, which we call tolerance bands, and there's a bunch of math that goes behind this based on, you know, volatility and these are relative features too, right? So once it goes outside of these tolerance bands, yeah, I get a big red flag on my screen that says, you know, here's an account we need to look at rebalancing, right? And then from there we go in, and if it's in an IRA, it's really obvious, right? We'll make that change right away. If it's in a taxable account, so like a non-qualified account, it takes a little bit more work because we have to be cognizant of any you know, tax liability, right? A gain or a loss. So there's an extra step there of consideration for rebalancing, but it is so to answer the question, I think it's important that you scan. I mean, we scan every day. I think you have to, because as you've seen recently, like markets will move at one point markets moving 10% a day in both directions there for a little bit a month ago. And like that's when you need to be in there really rebalancing. And otherwise you're going to end up with not enough stock. And, you know, maybe some of you have felt that in these last few weeks, but a really good question, Jim. Okay, a new question just came up. That's along that same point. So question is, how frequently in a year is an account typically rebalanced? So this is a great question because it's all dependent on volatility. So some years there'll be zero, right? So for example, like if, and again, back to our really simple example, right? So let's say you know, you're 50% stocks, 50% bonds. And let's say both of them go up 10%, right? Or both of them go up 20%. Well, that's not going to trigger rebalance because you're still going to be 50-50, right? Now, in years where there's tremendous volatility, we might be rebalancing accounts, you know, 6 or 8 times. And I know, you know, for the purpose of today, and this is a study on, you know, kind of declining markets. And so we were discussing, you know, rebalancing on the downside. Well, like on the upside, like you got to be doing the same thing, right? If when markets are ripping higher and markets are ripping higher, and if you're not careful and you're not rebalancing, you're going to become really equity heavy, maybe like as you're retiring, right? Which that could be really bad if you're coming into a crash at that time, right? So it goes both ways. And so really good question there. And I wish there's a better answer, but really it's how frequently. It all depends on volatility and that what's happening at that time in the market. Okay, well, a lot of questions are coming in. So another question here: how often do you look at tax loss? Okay, so another really good question. So tax loss harvesting. This one's a little bit more subjective, right? So it's less model based, right? So rebalancing, like this is all just models that I think it's really important that everyone's looking at all the time. Tax loss harvesting is a little bit different. There's a little bit more subjectivity to it because when you have a giant market decline like we did, it's just really obvious. So we just start looking at, we start looking at all the non-qualified accounts and where can we start harvesting losers so we can create carryover losses. Where can we start doing this? In a year where that we don't have as obvious as a decline like this, typically we just do this at the end of the year. It's something that we do in November, December. Like we'll just look at a portfolio and we'll say, was there a pocket of the market that just did poorly this year? Maybe it's, who knows? Maybe it's commodities, or maybe it's small caps. Like maybe it's that there might be a certain pocket that did worse for whatever reason, and like that would be the position that we would tax loss harvest. But yes, so to answer that question, it's like whenever there's a big drop, like that's the obvious time. So like we've already gone through, you know, all the non-qualified accounts. Like we've harvested a lot of you know, positions that we're doing poorly. And so we're probably, unless the market makes new lows, which could happen, like we're probably pretty close to done tax loss harvesting for our clients. I would take a couple more. I don't want to go too late here, and there are just a lot of questions here. Do you rebalance more if a person is closer to 72 when we have to start taking money out? I don't know if you guys can hear that. There's a cat behind me. So, so a good question, Ken. Do you rebalance more if a person is closer to 72 when you have to start taking money out? So the answer to that is your asset allocation. So we might slowly, as a person gets closer to retirement, like their overall asset allocation will naturally become more conservative. Like we're going to want to make that more conservative. But from a rebalancing perspective, like no. So we wouldn't rebalance more just because of age. Your asset allocation, like your mixture of stocks to bonds, that should already be adjusted. So in terms of those tolerance bands, that's a systematic, that's an important thing to do regardless of age. So no, we would not rebalance any more or less depending on age, because everyone's going to have different models and different levels of aggressiveness or accounts more conservative. Okay, just do, maybe I'll do. Scott, Scott just asked a higher level question. Scott, I'm going to answer that one in an email. That one would take longer, longer to answer. Good question though. Yeah. Okay. Yeah. Mark, nice question. Mark, another possible, do IRA conversions to Roth. Yep. So this is something we're considering. We've been doing with a handful of clients. So with IRA balances lower, converting to Roth, and especially, so of course with the CARES Act, the whole stimulus package, you don't need to take required minimum distributions for 2020, which is crazy, meaning, you can begin converting money before even taking your required minimum distribution. Just one note on that. It's really important to look at your tax map for that year, for this year, because what we're finding is a lot of people that if you're taking the majority of your retirement income from required minimum distributions in the past, many people have been surprised to find like you might not have to pay any taxes this year, right? And so, right, because Social Security taxes are based on your provisional income, which is based on your other forms of income, right? Like RMDs or pensions, so forth. So by eliminating the RMD, for some people, you might be better off paying no taxes this year than doing a Roth conversion. So very specific to each person's circumstances. Okay, so there's, like I said, we will personally respond to, there's a few questions here we haven't been able to get to. And Scott's question was, I need to have a talk with Scott about that, because that's a great question, but I'm going to respond to that personally. Everyone, thank you so much for taking the time. Hopefully you found it helpful. Again, we can't wait for to be able to see many of you in person again, shake hands, give you guys hugs. This is obviously a difficult time, and we appreciate you taking a little bit of time out of out of your day to hang out with us for, I guess, yeah, almost an hour. It went a little bit longer than I thought, but we hope you enjoyed it. Any feedback is always greatly appreciated. We like getting better. Looks like Patrick kept the webinar going, so I think he succeeded. I hope you found it somewhat helpful. And again, if you think of additional questions, please let us know. We love helping. We love educating, and so let us know. Hope everyone has a nice rest of the Thursday, and we'll talk to you soon. Thanks.